Everybody, and welcome. If you haven't found a seat, pick a seat and make yourself at home. We're absolutely delighted to be able to have a face-to-face briefing again this year, but more specifically, that for the first time in 3, maybe almost 4 years, we've been able to bring a couple of investment managers from Hong Kong, and we're grateful to them for giving us their time. And we'll introduce Frank Tsui and Gordon Nip a bit later as we go along through today's program. Now, for those of you who don't know me, my name's Paul Harding-Davis. I'm the CEO of Premium China Funds Management, Premium Asia Funds Management, and it's my pleasure to also be your MC for today. The disclaimer, I will take a few seconds on it just to emphasize that this presentation isn't an offer, it's general information only. We don't and aren't in any way taking into account your needs, objectives, or personal circumstances. You should, as always, seek, and I know most of you are advisors, but you should seek in your own professional advice. I, like you, have my own advisor as well. So, some housekeeping. Firstly, mobile phones. Can I just remind you to put yours on silent? I'm pretty sure mine is. It's on the table over there. Hopefully it doesn't ring while, and I'm wrong. Emergency exits out the door there, but mainly just follow the instructions from the staff here at EST in the event of any emergency. The conveniences, the gentlemen, the ladies, are out the door past the lifts and turn left, and you'll find them there. And I'll go through the lunch program shortly. You can see the menus on the table. Can I just ask, if you did express a dietary requirement, if you could alert one of the team here at EST to just hold your hand up and let them know that you have a special dietary requirement. So, a few times during this lunch, we're going to go to Slido and ask you some questions. You can access it in 2 different ways. The easiest is that QR code on the table right there. If you could just find that and register, or you can go online to Slido at the web address there. That's the https www.sly.do. You'll then need to enter the code that's below, which is the AIB 2023. But the QR code that is on their table is the easiest way to do it. Okay, so we're going to go through quite a lot today and finish with a Q&A. I'll touch briefly on a scene setting on the China reset. We'll get a business overview and then go through the market outlook for equities and the income fund and credit market outlook before we finish with the Q&A. So we'll have all 4 of us up here at the end and giving you plenty of chance to ask questions. So, very quickly, the China reset that we talked to you about in the correspondence that you would have seen quite a deal of coverage on. I'm referencing a quote here from Professor Tim Congdon from the International Monetary Institute. You'll hear some of these points a few times throughout today's presentations, that there have been astonishing announcements about future policy in China of recent times, which almost amount to a complete reversal of what was going on for most of President Xi Jinping's period as the leader of China. COVID lockdowns being removed. China is a little different to most of the other major economies because it has low levels of inflation. That means it has capacity and scope to do a lot more than some of the other nations in the world. And as a result, China is in the process of implementing a range of things, but I'll let others talk to you more about that later. And there is a better tone between the East and the West at the moment, and we think that Xi Jinping and his government will have more focus on growth and on keeping his people happy. Ergo, they'll be perhaps a little less reactive to what the West has been doing. I think some evidence of that is in the next number, that there's been a 20% increase in foreign investment in China near the end of 2022. So as a result, he concludes, Chinese development will be positive for the world economy in 2023, unlike what's going on in the main Western economies, which are struggling with inflation. So that's a very quick scene set. We'll continue the scene set by introducing you to Li Cheng, China's new premier, a member of President Xi Jinping's close-knit team. And this is an abbreviated video of his first talk in his new role. And I'm going to call Jonathan up while this plays, but this will scene set some of what Jonathan and Frank and Gordon will all be speaking to you about. So please enjoy the lunch, and I'll look forward to speaking to you near the end.
今年我们中国的经济增长的预期目标啊，现在定5%左右，这是综合考虑了各方面的因素以后确定的。当然，现在我们经济总量大了，我们总量已经过了120万亿，而且现在新的挑战也不少。在这种高基数上，要达到这么一个5%左右的增长目标，恐怕也不是件容易的事，需要我们倍加努力。人口红利既要看人口数量，更要看人口质量；既要看人口数，更要看人才数。我们国家现在劳动力总数，或者准确表述应该是适合劳动年龄人口，已经有近9亿人，而且每年新增劳动力是1500万人。人力资源丰富仍然是我们中国一个巨大优势，或者说显著优势。更重要的是，我们国家接受高等教育的人口已经超过2亿4千万，每年新增的劳动力平均受教育的实现年限已经达到14年。因此可以说，我们的人口红利并没有消失，人才红利正在逐步形成，发展的动力依旧强劲。在美国国内啊，这几年有人在炒作中美两国脱钩的论调，有烧还比较热，但我不知道到底有多少人在这种炒作当中真正受益。中美合作大有可为，唯独打压对谁都没好处。
Good afternoon, everybody. My name is Jonathan Wu. I'm one of the executive directors and the chief investment specialist for Premium Asia Funds Management. I actually chose to add that video in only late last night. And the reason why is because both me and Gordon and Frank spent the better part of the back half of last week in New Zealand to see our clients. And the overwhelming feedback that we received and the main questions that we received was, what are we going to do about geopolitics? It doesn't seem like the US and China are really all the way getting along. And I remembered that this happened on the 13th of March, that press conference you just saw. And I remember that press conference was 90 minutes long. And I knew it was scheduled and I was going to watch it. But what I thought in my mind was, well, this is the same old fully orchestrated press releases and press conferences, right? All the questions have been preset and no one's going to ask anything particularly challenging. I was completely wrong, because there were journalists from Spain and Uzbekistan that was questioning whether or not a zero COVID policy was all that beneficial to the populace, right? Let alone asking the question that you may have seen Premier Li replied with regards to the population dividend that China has had for many decades, every year adding to the population of the working class, as well as increasing the productivity of the population throughout all these years. You would also note in that video that the way that the Chinese government is standing with regards to the US-China relationship is far more cooperative than poking a bear, right? Because they say if the two of us end up in some sort of conflict, it's not good for anybody. And one of the things that when I started in this role almost 20 years ago was that most of you that have been on that journey with us would have bought into China or Asia on the basis of an export story. China is the manufacturer of the world. Today, and Frank and Gordon are going to talk about this, the reason and rationale why you buy China or Asia is a localization story. We build our portfolios to ensure that geopolitical risk is almost non-existent. Can you believe this coming from a fund manager saying, okay, if something breaks out, if Taiwan gets taken, can you build a portfolio of resilient stocks? We believe that we can, and we will show you. Slido, just to test everyone out. Here's the first question. Also note that I built all these questions 2 weeks ago before SVB happened and what Credit Suisse has also recently happened in the last 48 hours. But how concerned are you about how expensive the US and Australian equity markets are? I want to get a taste for what the room is feeling at the moment. Because if we have a contagion effect with regards to what's happening in the banking world at the moment, those valuations seem rather concerning. Because I put forward a hypothesis to you. If I told you last week that the 16th largest bank by deposits in China, called the Shanghai Venture Bank, collapsed, and it may create a run on deposits, that was the basis for it, right? On one day, someone pulled out, or investors or depositors put out $42 billion US out of the bank and caused it to collapse. Would you reconsider your allocation or any allocation you have in your clients' portfolios to China? Question mark. Most people would. And the most people would is because you do not necessarily understand the full context of what's happening. But why I put forward that hypothesis is that most of you in the room probably saw SVB go down, but didn't think too much of it. Or you didn't reconsider your US equities allocation right at that point. But I can tell you, after being in this role for 20 years, I see the opposite and the way people react to negative news out of China. Because there's rarely ever any positive news out of China, right? When was the last time you saw a positive piece of constructive news about China? Right? Very rare. The incredible thing is, even up to today, we are still the largest Chinese equities retail strategy in the country. We're also the largest emerging market debt strategy, mainly because most emerging market debt strategies are pulled out of the market because the returns have been so bad, right? And this is talking from a person who's also a chief investment officer of his own family office, right? Because the question is, are you sitting in the glass half full camp at the moment, or are you in the glass half empty? And this is in a global context. If you are the glass half full type of person, in the last 25 years, looking at global returns, equities have outperformed high yield, right? Because that's what we offer. We offer 2 equity strategies and we offer a high yield strategy. If you are a glass half empty sort of person though, then that was your return profile. Now this is sort of like a motherhood statement, right? But I just want to contextualize this because this is at a global level, right? Now, we all know that post the lockdown era, what did we see happen in economies? Locally here, what do we have? Revenge spending. Well, this is what us Chinese people call it. We call it revenge spending. After being cooped up for 3 long years in our houses, what do? We spend like crazy. But have you noticed that in the US and even in Australia, in the last 2 months of retail sales data, it's still reasonably okay, but we're funding our consumption out of credit. That's dangerous, right? Regardless of what your thesis is on the direction of US rates post Credit Suisse, SVB, Signature Bank, so on and so forth. Because if we consider the actual metrics, China is now about to unleash a ridiculous amount of savings into the system. As you saw, the Chinese government target for growth is 5%. Frank will talk about it a bit later, but by unleashing those savings alone, it will be 4 of that 5% worth of GDP growth already in the bag. Where the government backstops is if there is a shortfall on consumption, then the government will backstop it using fixed asset investment. And the best way to view fixed asset investment is look at the speed of local government bond issuance in China. That is your pure indicator, because when the government brings forward at the beginning of the year and issues more government debt, local government debt, then you expect that the stimulus towards infrastructure spending goes exponential. The other thing to note is that, guess what? China's net exports has a 0 contribution to GDP now. So if we all remember our economics training, the 2 remaining parts of GDP growth are consumption and government spending. And that's what we focus on. See, the other side of it is a problem. Household debt divided by GDP, China is also on the winning side of that at the moment. These slides will be sent to you afterwards. But that's not actually my point. If you then overlay the bars over each other, what do you see? China's got a net savings of 44%, and the US has net savings of negative 28%. That's a pretty big bloody problem. What is going to fuel the consumption of the United States public going forward is highly questionable. Then the third premise I want to put to you is that in my 20 years, and I've sat down with a lot of you and proposed the valuations on Asian equities or Chinese equities is quite cheap, right? This is probably a good opportunity to get in. No, Jonathan, it's okay. China's always cheap, right? It's always been cheap. Nothing really changes, right? Well, there's cheap, and then there's ridiculous. Does anyone know the P of the Hang Seng Index at the moment? If I make a basic premise to you, ladies and gentlemen, that we say we are achieving no earnings growth in our portfolio, which is impossible, right? Achieving no earnings growth in our portfolio, but all we have is a little bit of increased confidence in the market, which leads to a 10% expansion in the PE ratio. Then after year 1, after year 2, and then after year 3, we just get back to the 5-year average of 10 times earnings. If my men and women, of which there are 50 in Hong Kong, are worth their mustard and can choose companies with earnings growth, that is the extra cream. That's how cheap the market is. If I propose the same thing to you and we were in Australian equities territory and you've got 7.6 times, what would you say? It is ridiculously cheap at the moment, priced every single part of the market to pretty much obliteration. So then I ask you the next question, after what I just presented to you, which some of you may go, Jonathan, this is one of those classic loaded questions, right? You gave me really good statistics, and then now you expect me to answer, yes, it's attractive, right? Because after what I just presented to you, and before I get Gordon and Frank to talk, you may still think it's not attractive, right? Because you think there's a lot of risk. And obviously, hopefully in the next hour and 15 minutes, we hope to give you a little bit more confidence in what we're doing. All right. To give you a quick update on Value Partners. So Value Partners, as most of you know, started in Hong Kong, a value-based local fund house, right? Not a big name, just a local fund house started in 1993. So they're on the cusp of 30 years in operation. They're listed on the main board of the Hot Stock Exchange. Market cap's around 200 million Australian dollars, but critically, just under half the equity of the business is still held by management and the founders, which means that Value Partners sits in a very unique space where they have to be incredibly transparent to the market because they're a listed company, right? That should give you that extra level of confidence. One of the things that I learned earlier on in my career is that you can't be good at everything. In actual fact, that's probably a life lesson. When you consider investing globally, have you ever considered giving your global fund allocation, giving your Australian equities allocation to a global fund? Right? No. Why? Because you believe that there are local specialists that'll do a good job. We have 50 men and women that don't know anything about US equities, European equities, Australian equities, or Kiwi equities, and we only do Asia. 50. 50. Okay? Split across offices in Hong Kong, Shanghai, Shenzhen, KL, Singapore, and London. Okay? What are we good at? We do 6,500 company visits a year. That's all we're good at. We're really good at having conversations with people. These are not broker calls. These are not things organized by investor relations. This is Gordon WeChatting a CFO of a company and saying, hey, can I have a conversation for just 20 minutes? We're in lockdown at the moment. I want to understand a bit more about your earnings because I can't make it work at the moment. That's what we're good at. It's nothing special, but our IP is purely in the fact that we have the depth of knowledge and contacts in the market. And about 6 years ago, the team decided to create a more consistent application of investor funds across different portfolios. And so we created these high conviction groups. And it's basically roughly split by sectors and then partially by geography, as you can see there. And what you see here is that the depth of knowledge is incredible, right? So the PM of the Premium Asia Fund and the Premium China Fund is Renee Hung, who's also the sector lead for IT hardware as well as Taiwan. And what you see here is that what the PMs need to do is, in each of these sectors, they've got analysts that report through to them. Each of these men and women need to come with the 5 best ideas. 5 best. That's it. 5 best ideas. That's a lot of drilling down to come with just 5 ideas. And then the PMs need to make up at least half of their funds out of the high conviction list. That's how the portfolios are structured in a consistent way. The other thing is our funds offer you the diversification you need. And I think in this day and age, correlation can be a killer. Correlation does not equal returns, but correlation gives your clients a better experience through the cycle. And what you can see here is that outside of, obviously, EM itself, the correlations go all the way from about 0.2, 0.3 to about 0.4 or thereabouts. So blending us into your portfolios gives you that edge through the cycle, okay? Many of you know this is a slide that we put up every year. In 2019, 1st of July, we decided, how do we give better value to our advisor public? So we rationalized our entire fee model, both on equities and on fixed income, and we removed the performance fee on the Premium Asia Fund and dropped our fee from 178 to 133 to make it competitive. Why did we choose 133 basis points? For those of you that understand Chinese culture, 3 is an awesome number. For those of you that aren't aware, 133 is exactly 2 basis points cheaper than Platinum Asia. And this is our track record versus Platinum Asia versus the bench. So that whole track record you see from inception in 2009 all the way through to 1st of July 2019, our fee was significantly higher and we still beat them hands down. This is important because this is 2 parts of it, right? One, you don't have the understanding in Asia, then you outsource it. Can that manager prove to you a long-term track record? Yes, we can. Is it at a fee rate that fulfills best interest? Yes, it does. Tick, tick, tick. Our funds are pretty much on most platforms. We're very pleased that it was re-added back onto Panorama last year. So that one, it was a big relief for many advisors who'd been wanting to reallocate. So if there's anything that's not on there, you will receive feedback forms after this in your inboxes. Please fill it in if it doesn't, if there's one of the tick boxes that you don't, that you use that it's not on here. So with that, I'm going to introduce Frank Tsui. Frank was in the country in 2018. That was the last time he was here. And Frank has changed roles slightly in the last couple of years. He's now Managing Director, Senior Fund Manager, and Head of ESG for Value Partners. Now, many of you may think that's kind of funny. ESG in China seems to be an oxymoron. I assure you that it isn't. It is simply another bridge that you have to cross because most companies in Asia don't report ESG things like we do in Australia and Europe and the United States. And VP has genuinely created a business model around ESG, and later on we might talk about that, but that's not so much for today's topic. So Frank joined Value Partners 8 years ago, and he's always sat within the equities team. And so Frank, if you could join us, and Frank will give you an idea about where China and the rest of Asia's economies are at, and also give a rundown of our portfolios and where we stand. Frank.
Good morning, everyone. Oh, well, actually, good afternoon, everyone. Thanks for spending your time with us, and thanks for supporting the funds for so long. Okay, there we go. I was just looking at the screen, and I just realized there's one at the bottom here. Okay, as Jonathan just mentioned, this is actually my second business trip in over 3 years' time. And that explains why China is in a different cycle versus the rest of the world. China just reopened the economy by exiting the anti-COVID policy. So there has been a lot of pent-up demand, pent-up... what is this for? Okay. There's a lot of pent-up demand that is going to be released in the economy. While we believe the developed market is very likely heading into a recession, including US or Europe, next year, if not this year. Emerging market, to a certain extent, we think they are still seeing growth, but it's decelerating, especially in the Southeast Asia, when the growth was pretty much driven by commodity price inflation last year, that we think the rally is almost done. Like it or not, it's in a better position driven by China. I think this is largely because China, being the second largest economy in the world, that they're reopening up. And a lot of the trading partners within Asia will benefit from that. And if you look at why I'm saying that is the bottom left-hand side of this chart, look at the valuation versus the earnings per share growth. China stands out. Asia is actually trading at around, say, 13 times PE, but earnings per share is about 2% growth, whereas China is actually trading at about 10 times, but EPS, earnings per share growth, is actually looking at 14%. The bottoming of the derating cycle is also happening in China, and that leads the MSCI Asia ex-Japan as well, that you're looking at the bottom right-hand side of this chart. The derating cycle started in 2020, 2021, and is actually flattening out and is bottoming out. And this is what we're expecting in 2023. And I think this is also the reason why Jonathan mentioned about why China is important for at least 2023. We turned much more bullish about Chinese equity market. Well, I represent equities, and Gordon later will represent the fixed income. We turned more bullish on Chinese equities in late October to November last year, simply there were 180-degree reverse of three important policies in China. What has been driving a very distressed value in Chinese equity market the last few years' time is the anti-COVID policy. As I just mentioned, I just started to travel just lately. And this removal of anti-COVID policy actually is going to resume the consumption in China. So this is first thing. This is a big reverse. The second reverse of the policy direction since late last year was the common prosperity policy that puts a lot of policy constraints in different sectors, including the platform companies. Platform companies is actually referring to the e-commerce platform, which has been seeing a huge policy headwinds in the last few years' time, that you saw Alibaba from a very high growth company turning to a very good value company. And literally, there has been a big sacrifice on some of its top line and bottom line growth. And also about the third major policy reversion, that's the property market, which I believe Gordon will mention in details later, because that actually has also affected the developer issuers in the Chinese property bond market quite severely the last 2 years' time. But what I would like to say is the common prosperity and all this removal of the anti-COVID policy is driving a much more positive outlook in Chinese equity growth profile. Reasons being is, I would always say China likes to control everything, and that's the fact. Policy, what the policy direction is heading to will dictate your share price performance and your portfolio performance. The last few years have been extremely challenging just simply because the direction has been a headwind for a lot of the growth profile of companies. We had a tough time that every single time when there was a policy announcement, we have to revise our financial models quite drastically. Education, as an example, that when policy came out, we almost had to wipe out 50% of the earnings expectations on a company. And this applies to other sectors such as healthcare sectors. Also, the e-commerce platform that actually has, we have seen quite a drastic revision of our financial models over the years. But I think this is something that we have been dealing with the last few years' time about increasing material of the impacts from not only the policy but also geopolitical tensions. We have always been claiming ourselves as a bottom-up stock picker, but geopolitical tension and also about the policy impacts are something that we cannot ignore as a Chinese equity manager. But one thing I would also like to talk about is the how do you understand about the common prosperity initiatives? I think there has been a lot of people that has been really freaked out because of the common prosperity policy that's being rolled out by the Chinese government that wiped out a lot of earnings, and making Chinese equities, whether it's investable or not. I would just like to take a step back and talk about a little bit of a history about President Xi versus the previous presidency. Before President Xi came into the office in 2012, Chinese government has only one objective, was to double the GDP in about 10 years' time. So it was more of a whatever it takes approach to drive growth. And that creates a lot of issues, such as overcapacity issue, over-leverage issue. And there's been a lot of local government that has been taking on this agenda by massively and overspending in some local government projects. So when President Xi came into the office in 2012, he has been really, really consistent on fixing issues. First is the overcapacity issue in the upstream commodity sectors. So if you remember 2014, 2015, there were a lot of steel mills in the northern part of China that is being shut down because there has been a lot of property infrastructure development to support the economic growth after the global financial crisis in 2008. So there has been an overcapacity issue, and he has been really fixing the issue. That's one part. Second part is the shadow banking. Deleveraging the shadow banking was actually part of his agenda. That was back in 2015 and 16. Common prosperity in the last few years' time was more of a preemptive measure to avoid bubble in specific sectors. China is actually a developing country, so obviously something could grow very rapidly. If you don't put a control, if you don't take a preemptive measure, it could easily form bubbles, and that's exactly what the common prosperity is coming after. They are trying to make sure there's a sustainable growth without the formation of bubbles or asset bubbles in different sectors. Taking Alibaba as an example, they grew so fast that they became a dominant player in the e-commerce platform, and they were almost like a monopoly that they don't allow merchandiser to choose more than one platform. So that's Taobao, that's Alibaba's platform. So one of the platform reform was to promote a fair competition so that other e-commerce platforms could come into play and to gain market shares. And that literally has hurt Alibaba's top line growth and bottom line growth because there's no more dominance in the market. So this happens also in healthcare sector, education sector, and also some consumer sectors as well. I think the overall agenda is to make sure companies don't grow too fast and don't dominate and don't become a monopoly, and they will sacrifice some of the near-term growth, but to promote a more healthy long-term growth. So judging from that, we had also gone through a very difficult moment, as I mentioned earlier. Every single time when these policies came out, we have a tough time to adjust what are the impacts to the portfolios companies that we have invested. So, but I would just like to say, it seems to us the worst is behind us. It has been a policy headwind the last few years, but these 180-degree change and reverse of these policy directions have made this a tailwind for Chinese equities. And this is the reason why we changed and become much more positive on Chinese equity market since late last year. So the reopening has been driving strong rally in Chinese equity market. So, where we're at right now. I would just like to say, just in the previous years, I think there has been a lot of frustrations and also distressed pricing on Chinese equity market that make the valuation at extremely low level. That was in November 2022, when the 180-degree reversal of those policy, market just rally. But that's not because of the fundamental change, but it's more about the re-rating on expectation. Because people were pricing in very conservatively about Chinese equity market in 2023 prior to November last year, that they did not know when the anti-COVID policy will be removed. That has been trapping a lot of consumption power within China. So once that's being removed, together with the common prosperity and the property market policy, things just got reversed completely. So that's what we generally call the mean reversal. So to us, as a bottom-up asset manager, it was extremely difficult to outperform the market during November to February, because everything just came back up. Everything, all sectors just gone up. So no matter what you pick, no matter how good the company is, you could just blindly throw in your money into any stocks that could easily give you 50% return or maybe 100% return if you buy Alibaba. So, but we're actually even more exciting right now because we think the mean reversal has completed, and it's now going back to fundamental-driven kind of like situation. That bottom-up stock picking will be a good source of alpha going forward from here. And after this, kind of like rally, we think the valuation remains at low level. I would just like to highlight the bottom line. That's the gray line. That if we're taking MSCI China, excluding Tencent, excluding ADR and A-shares, it's trading at about 6.5 times PE versus the long-term average, which is 8 times. We think this is still at a very attractive valuation level. I know this is something that Jonathan has also brought up a little bit. Our views on the rest of the Asia market, well, actually is a bit mixed. As I mentioned earlier, the Asia equity market or the strength of Asian equity market will largely depends on the China reopening. In Taiwan, we're slightly more positive relative to southern part of southern part of Asia. I think Taiwan has gone through some big devaluation, not only because of the tech cycle, but also about the geopolitical tension, which we think the devaluation has pretty much priced in a lot of geopolitical risk. We also think the inventory correction is actually coming to an end. That makes some of the tech names become more attractive at the current valuation. So as long as people we see that are pretty much pricing in the geopolitical risk, we think the downside risk from here is rather limited. I mean, of course, never say never that we don't know what's the outlook of the geopolitical tension. If that intensified, that would definitely be a negative factor. But to us, when we were just looking at different companies that we invest, when we talk to them, Taiwanese management in general, especially the tech companies, are telling us that capacity has been filled up not only in 2023 but to 2024. So that means their confidence level is extremely high for majority of the tech companies that we research and we invest. Korea, we're actually just a bit more neutral to slightly underweight. Reasons being is we think it's still kind of dealing with the inflation factors and also about the normalizations of interest rate hike cycle, and it's also extremely sensitive to external trade situation. That we think if our assumption is correct that U.S. and Europe are heading into recession, Korea is likely to face headwinds due to all these external weaknesses. And South Asia, we're actually just being a little bit more cautious after the strong rally in last year, especially in the first half of last year when the Ukraine situations actually has worsened and then driving up a lot of the commodity prices. And that also drove a very strong rally in South Asian countries as they're actually the commodities exporter. Valuation actually has become much more reasonable, not rich yet, but reasonable, and that actually has been seeing a bit of a valuation gap between South Asia and North Asia and China in particular. India, we like it. It's a structural, secular, long-term bull market, but just valuation at a very extreme level if you look at the bottom right-hand side of this chart. So, this is, all the kind of the views like after the perfect storm in last year. So I'd just like to spend a little bit more time on the China market. I know there has been a lot of, talking or topics, controversial issues with China versus the last time I visited Australia. But one thing I would just like to talk about China is the evolution of the growth cycle. And I think this should be the perception on China for, say, 5 years, 10 years down the road. If we look at the China GDP growth history, they have been evolving over time. That from 2002 to 2007, that was pretty much driven by exporting lower value chain of goods such as textile, toys, lower value chain kind of like electronic goods, because that's the time when they first joined WTO. 2008, after the global financial crisis, as I kind of like touched on a bit earlier, it was mainly driven by the government investment. So a lot of the infrastructure properties driving the GDP growth of China. So that's very much government investment capital driven. And in 2016, it was more about consumption, because of the rising middle class. The e-commerce platform is driving the consumption shares of the GDP growth components. So what's next is 2022. I think geopolitical tension plays a big part of this China growth evolution. I believe there are not many options left for China but to focus on domestic economy. I think the last few years we have been really looking into what are the macro impacts, despite we're a bottom-up stock picker. 2018, I still remember when Donald Trump came into the office, every single time when he put in executive orders, sanctions, trade wars, again, we have to revise our financial models completely. We have to measure what are the impacts and whether companies that we research deserve certain amount of premium in our portfolios. So, and that's why I said, something that we cannot ignore is the top-down macro policy directions, and actually the materiality of that keeps increasing. So, and that actually leads us to believe China has no options. Every single time when China actually wants to go out of China, such as on technology, even on healthcare product, they have biotechnology, drugs, like all this kind of products that they want to go outside of China. They face strong resistance by the Western countries. So unfortunately, that has been putting in a lot of pressures on China's outside of China's growth. So if you're, the government officials of China, definitely you would just want to, manage that risk by localizing your growth, and that's consumption. And I think this is, coming to a good timing as well, that the rising populations of middle class in China, that is driving consumption upgrade. Unlike the last cycle, consumption upgrade is actually, driving the premiumizations of the product purchase by the consumer in China. And that means people, a company that we research, Mengniu, that's a dairy companies, they used to produce milk. Now they're actually, they bought the Australian milk companies that is supposed to provide good nutrition to the citizens. But the dairy products, including yogurt, that's what we call the premiumization process. They're selling more this kind of like premium products that could give 30% jump on margin. In China, it's giving them a very strong re-rating story. So if you look at the premiumization process, because of the rising middle class, the consumption upgrade does give a very strong conviction for us in China. The second part is the innovation. Innovation, we're not talking about the technology semiconductor, because that actually has been seeing strong resistance and sanctions by the US. We're talking about the industrial innovation, which I'll touch on that a bit later. And the service industry expansion. China's service industry takes up a very small amount of GDP growth contribution versus the rest of the world, and that still see a lot of upside from that. When I say consumption, I think the COVID actually has been restraining a lot of purchasing power. If you look at the chart on the left-hand side, before COVID, a household would spend $70 out of their $100 income in China. And because of COVID, now they are spending only $64. So the reopening is going to release that pent-up demand that has been sitting aside in the during COVID. But we think this is actually not, the reopening is not only a short-term story about China's consumption. Jonathan mentioned a little bit about the China savings rate. I think if we're looking at China's savings rate versus the U.S., and if we are actually assuming the savings rate goes down to where the U.S. Is at the current level in the next 10 years' time, it will contribute to 4% GDP growth on an annual basis. So remember the video that showed earlier that the Chinese, the China new premier was saying 5% GDP growth is not easy to achieve. I agree with that, but it's more about how they are shifting and release that consumption into the economy in the next 5 to 10 years' time. And when we were just talking about innovation, we're talking about industrial innovation. That means electric vehicle, renewable energy components. That's more on the upstream supply chain. EV, I think everyone knows that demand is extremely robust all around the world. It's not only about China. If you break down an electric vehicle, 50% of the components came from Chinese companies. So we're just looking at the components part. That's give us a very strong convictions about Chinese company will continue to benefit the industrial innovation part. And on the renewable energy equipments level, the components such as solar panels, solar glass, the polysilicon, all these components takes up over 80% of the global market shares. This is something that is extremely irreplaceable by other countries. I'm aware that the U.S. and other Western countries are starting to, ally and rely less on Chinese companies on providing the renewable energy components on the upstream levels. And that's where the U.S. is building a lot of factories and giving a lot of incentives to build factories in southern part of the United States. We think this will take a very long time to take away China's market shares in that particular area, because China is actually it's advanced in those components level, and also at the same time it has always have the cost advantage over the other countries. Last but not least, sorry, just going back, the services industry, I'd just like to highlight one thing, that the property sector had gone through dramatic change, that the citizens' perceptions on property investment in China has changed upside down. Citizens in China no longer believe the property market is a guaranteed return asset class, given what had happened in the last few years' time, and Gordon will mention about that once again. And what's left in the savings on the asset allocation is, we believe this is a big incentive for Chinese household to reallocate their assets from property into financial services. And Chinese government and the policymaker has been really building a lot of policy to ensure this is happening by approving new financial products, and also by making the wealth management platform much more easier to operate. So there will be a transition from the asset, from property to the wealth management platform, and this is also the reason why we have been, focusing more on the financial industry lately in our portfolio. So this is, kind of like an overview of where we expect China is heading to 5 years, 10 years down the road, and this is also driving the change of our portfolio construction. So this is the top 10 holdings of the Premium Asia Fund. 7 out of the top 10 holdings are Hong Kong Chinese listed companies, and they are all having domestic revenue exposure instead of having external risk exposure. So companies such as China Mobile, China Telecom, Alibaba, Meituan, all these names are, fits into, what we think is more sensible, that we're avoiding geopolitical risks, tensions, and also focusing on domestic growth that will be driving the re-rating story of the China economy. The top holdings, TSMC, that you're seeing, could be a little bit controversial. that people are thinking, okay, what's going to happen if Taiwan is going to face a huge political event risk. We think TSMC is a bit unique in the sense that it's the most advanced semiconductor foundry in the world, that no other companies can replace them. That being said, it has a very complicated connections with not only China, but with the rest of the world. So I'm not sure if anyone just had that invested or researched TSMC. The semiconductor technology advancement that they have is they're actually doing the 3 nanometers semiconductor. The lower the number, the more complicated it is. And Intel is actually only doing 7 nanometers right now. And TSMC is advancing to 2 nanometers in 2024. So we think because of such unique technology advantage of TSMC, we're actually quite comfortable to hold it as the top holding in our Asia portfolio. And not to mention about the advanced technology that TSMC has, it's benefiting from a lot of the AI developments such as ChatGPT lately that has been driving a lot of I'll say complicated and advanced chips demand around the globe. And this is also the same for Premium China Fund, that we're buying companies that are very domestic revenue driven. So we'd just like to say, as a bottom-up stock pick manager, we have been very nimble just to select companies that will ride through cycles. And I think if we were just looking at getting China exposure, let's say through passive vehicles such as ETF or index exposure, it's tough to get a good return. Reasons being is you have Alibaba, which we have in the portfolio, but we underweight versus the benchmark. If there's any policy that happens, Chinese policy, based on what we had seen the last 2 to 3 years' time, has largely focused on the big cap, the large company, because they don't want them to grow too fast. And if you're buying index ETF, that will expose you to some policy risk if they come back. So being as an active manager, I think China, if you're allocating assets to this country, I think active management is extremely important and crucial because we, as a bottom-up asset manager, we really have been busy doing research, and I could tell you this is an extremely interesting market that we have to change our views from time to time depending on the market situation. But I think that if you think the policy risk has been keeping you away or shying away from this market, as I said earlier, I think the restrictive policy cycle is behind us. It's more of a policy tailwinds that China policy is very pro-growth right now, at least for the next 12 to 24 months of time. So just stay tuned. I hope this could help a bit on the China and Asia macro environment. And I think I'll pass it back to Jonathan, and we'll let Gordon to continue the fixed income part. Thank you very much.
Thanks, Frank. We're now going to move on to fixed income. And obviously, the space that we play in is very, very different. By the way, I've been reviewing the questions that have come through. They're excellent. So please, on the slider, you'll see there's an ability to vote up questions that you think are more important, and so feel free to do that. Also, just a quick mention, on your tables you'll see the fact sheets to our funds, as well as an article that I had published in Money Management earlier this month, just on the China reset. So again, that's also great if you want to get copies of that to forward on to your clients. So in 2010, we sought out to build a fixed income capability. So Value Partners started their fixed income capability in 2009. Gordon joined Value Partners in 2009. And what we set out to do was, the world was very different, obviously, at that stage. And we said, what do we want to achieve and what do we want to build? We want to build a strategy to produce income for investors that's non-correlated to anything else in your portfolios that generate income. Okay, so obviously since then, that's sort of been 13 years later, or 12 years later, sorry. And obviously the development of products, you know, there's a lot of growth in private debt and things like that, but you're still seeking different ways to splice and dice your clients' fixed income exposure to generate a certain level of targeted income, but how many ways can you splice that? And we thought around 6% is probably a good target, okay? And what we're trying to do is, using the same style of investing in equities, we're trying to find undervalued debt, okay? This is both a sovereign debt as well as a corporate debt. It's primarily corporate. There are some times where we will tactically trade sovereign debt. For example, when Sri Lanka was paying 675 basis points, this is 10 years ago, not the last 12 months, we bought that. We'll buy Israeli sovereign debt at 475 points because there was a free 6% capital gain to be made in a week because everyone was happy to buy sovereign debt at under 5% and rode that very, very hard. All those sort of trades we call special situations. And some people will accuse me and say, oh, Jonathan, that's a euphemism for stuff that's gone really pear-shaped, isn't it? Special situations. Well, no, because the Israeli sovereign debt trade was exactly one of those. There's no risk. It's just free money to be had on the table, right? So it's primarily high yield. There's a little bit of investment grade. And what we do is, to de-risk the portfolio, we do a number of things. One, it's only hard currency, so we don't go and play local currency. I understand there are some fund managers that want to play local currency because they think that there's some capital gains to be had there. We don't want to make it so complex. Two, we run an active AUD-USD hedge. What that allows us to do is reduce the volatility of the fund's unit price because we reduce the mark-to-market movement of the underlying high-yield securities that we buy, which I'm going to give you a couple of examples of. Number three, we'll pay quarterly distributions. That's a nice, good income stream. That was the feedback we got from the market. Quarterly is good. And fourthly, they're all fixed rate bonds. And later I'm going to ask Gordon a question. Well, you're holding fixed rate bonds. Rates have gone up a lot higher now. What does that do to our cash yield? So we'll address those things with you today. Again, we just pride ourselves on doing really, really good bottom-up fundamental research. And so I remember this great story that Gordon shared with me a couple of years ago, and he said, I'm looking at these logistics companies, so you know, your FedEx, Ozpost sort of companies, right? Private sector. And they were saying, oh, we've got this many trucks leaving our logistics facilities each day, and this is how much revenue we're generating, da 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 da. And then Gordon sent one of his team in with one of those clickety-bobby things. You know the things you do to click for kids going on roller coasters? So literally had a private investigator. He hired a private investigator to sit in one of those facilities just outside in a car going, and the actual revenue numbers were actually full of crap. But that's what we do. Because there's two ways of attacking fixed income in corporate credit markets. One is you rely on external research houses like Fitch, Moody's and S&P to do that research for you. So it shortcuts one step. But then where's the value add as a manager? So we don't trust those research houses because the GFC proved otherwise, and we just take it as an FYI, nice to know. So we do the same bottom-up analysis as deep as we do for equities, but obviously the perspective is a bit different because we don't care whether or not how much money they make. We just make sure that they can pay the coupons and pay us the capital at the back end. And or if they're looking at refinancing the debt, making sure that they can actually refi it. So there are some circumstances in the strategy where we're actually actively helping the restructure of the debt, okay? And if we have time, we might go into an example of that. The team is lean and mean, and that's how we like it. And what we effectively have is a research and strategy team that you see on the left, which is made up of Anna Ho and Kimberly Wu, and effectively the two of them feed up to the PMs what's the best ideas. Now, Anna is a multi-award winning analyst, and she's ex-UBS. And what Anna is not only good at identifying a sector, right, as a sell-side analyst, but she's also great at saying within, let's say, a mining industry or car hire industry, which is in our portfolios, what are the names that we should drill into a bit more to look at? The other unique thing is that we've got a lawyer on the investment team. That generally can't be helpful, right? But nonetheless, the really good thing about having Alvin on the team is to ensure that we look at those contracts really, really carefully, right? Cross-collateral, cross-default clauses, all those things are critical in deal structuring on the debt side. Because it's very different to equities, ladies and gentlemen, because for those of you that are not aware, when you trade corporate credit, it's not like logging into ComSec and seeing the depth. The depth is determined by your depth of relationships in the market to find out who's holding this stuff, right? And then creating the trade. And Bloomberg is pretty much the only friend that you have to establish, and your dealing team, to establish the market depth. We promised that we'd pay your investors 6% cash distribution in hand every year without fail. We have achieved that. Right? So those of you that don't think we can actually fulfill this, I question whether or not you've looked at this carefully enough. Every year without fail, every quarter. Right? We're only 2 quarters in for this financial year. That's why it's half the current level. Never have we failed. We will pay a bullet to your investors at the end of the financial year if there is excess levels of capital gains accrued in the portfolio. That's what we do, right? And it doesn't correlate with anything else in your portfolio. This is the whole beautiful point about these strategies. It just doesn't correlate, right? So how you splice and dice your portfolio to get X whatever income target for your clients, well, we sit in the basket that's 6%. We're on major platforms as well, a little bit less than the other funds, but again, feel free on the feedback form to note down the platforms that you're interested in, and we'll help build a case for it. The other thing that I'm really pleased to announce is that we are the first ever Asian product to be added onto an investment bond menu. Okay, so for those of you that take the full, very long-term story, and I think investment bonds are a great vehicle, because they're 10 years, gives the opportunity for all the encapsulated capital gains to be tax advantaged, tax concession, so on and so forth. Both the Asia Fund and the Asia Income Fund are on the investment bond menu. Okay, so please feel free to utilize that at your free will. So now I'm going to ask Gordon to come up and speak. As I said, Gordon joined Value Partners in 2009 as a fund manager and then slowly moved his way up to be promoted to the co-chief investment officer in 2016 or 17. COVID has completely blurred my memory. Gordon's going to talk through the market, that is fixed income. He's going to spend quite a bit of time on property because I think that's what everyone wants to hear about. Because traditionally, our portfolio has had a higher allocation to property. And that has significantly, obviously, gone down in terms of the weight for us because we are incredibly dynamic in what we do. And then Gordon's going to delve into how we generate the yield and what's the fixed income market's outlook going forward after what Gordon likes to call an accelerated detox program. So, Gordon.
Hi, good afternoon. How are you? So I guess everybody's enjoying the food. So I think to start, before I start, I want to lay out 3 key important points, basically describing what kind of investment environment that we have. So borrowing one slide that, oh, I want to go back.
Oh, you want to go back? Sorry.
Yeah.
Yeah. How far do you want to go back?
26.
Oh, okay.
The decoupling. That. Sorry. Okay, so this slide, right? Basically, this slide shows you the world has basically decoupled, right? Globalization, no more, okay? Used to be in the old days where US is good, then China, Hong Kong is good. If China is good, then Australia is good, and so is New Zealand as well, okay? So give up that dream anymore, okay? The world has really decoupled, And that's why you see different markets, different countries, they start to move on their own phase. Now, China, as Jonathan and Frank just explained, that China basically is just coming out from ground zero because of the reopening, right? And then US and Europe and also other developed markets, arguably speaking, could be heading into a recession, maybe because of inflation, their own problem, or the banking problem. And the rest of the emerging market, basically kind of in the middle of China and developed market. So with this backdrop, I think just from an asset allocation point of view, it makes sense to have your thoughts to think about whether we should put money in Asia, including China, just because of different markets. They are now moving in different phases and different magnitude. Okay, we can start. So geopolitical and then the decoupling is number one. Number two is the yield volatility. We have seen a few weeks ago where the 2-year Treasury actually fluctuate up and down by 70 basis points, 7-0. And the yield curve right now is really, really inverted. So it's really, really hard to add on duration because it doesn't make sense, right? Adding on duration doesn't pay you much. And actually, if you look at all the personal account is doing, I think many people are doing just 3 to 6 month deposit because it pays, and you have the visibility that when you get your money back, and it's easy. Okay, so this kind of yield curve environment makes both investment, equity, and bond pretty challenging. Inflation remains quite high, and although on the left chart you see the U.S. headline and core inflation, they have actually come down, but it's not coming down fast enough. Okay, why? Because if you look at the U.S. inflation composition, sheltering and also energy actually has a big weight in the index. And the reason why sheltering will stay elevated because, common knowledge, right? If you go to rent an apartment, usually you only renegotiate the rent every 12 months, sometimes 24 months. So that process have the sheltering coming down. It will come down, but very, very slowly, okay? And coupled with the decoupling I just mentioned earlier, when every country, they try to hold on their resources, not sharing, and also make import and export expensive, all these, to me, at least, is really, really inflationary. So that two together alone makes us think that although inflation will slowly come down, but it could also stay at relatively high level for the foreseeable future. Now, given all these three together, no doubt investment is very, very challenging. But within this kind of environment, where can you find, as far as fixed income is concerned, when rates are high and volatility is also high, and also all the geopolitical risks creating all the noise, right? All the banking crisis. But I think in terms of relative value, as you can see from these charts, Asian high yield bond as well as China high yield bond on a relative basis, it still provide pretty good attractive relative values to developed market credits as well as emerging market credits. Okay, for high yield in particular, even versus its own history for the past decade, right now we are still offering, in terms of cheapness, 1 to 1.5 deviation on cheapness. Now, I'm going to mention about what happened to the China property, but if you look at this credit quality evolvement for Asian high yield credit since 2018, you can see the cream of the crop high yield credit, which is the double B, which is represented by the green area of this chart. Back in 2018, the double B credit was only around 30% of the universe. Okay? Fast forward to the end of last year, that portion has grown to almost 50% of the universe. And at the same time, if you look at the sort of the weaker hand, the B and below, back in 2018, it was like around 40%. And fast forward to today, it has already collapsed to 20%, basically half, right? And the reason why is mainly because of, as Jonathan mentioned and Frank mentioned, China property market. I talked to a lot of clients. I have always been saying, okay, if you are interested to invest in Asia, there's no way you cannot afford to look at China, whether you like it or not, because China is 50% of the entire Asian credit universe. And then if you zoom into China, again, you will find China property is another 50% of that universe. So that means if you are interested in doing Asian credit, you have to do Chinese credit, and you have to likely have to do China property in one way or the other. So the key is to understand China property, the boom and bust cycle, right? Frank mentioned that last year was a very challenging year for China property. In my world, in my area, it's not an understatement. A better description is obliteration, okay? Back in October, I think I can basically beat Simon in terms of early retirement. It was that bad, okay, at some point. But when things are going to the extreme, we can see the light at the end of the tunnel, right? So to going back and to just try to understand why the China property has gone through what Jonathan mentioned, an accelerated detox program, or often known as the Great Purge, is basically going back to the good days. Is every sector in China, including property, they were all growing using excessive leverage, meaning a lot of borrowing, right? So when Xi Jinping came into power, he realized that this is something just not going to be sustainable in the long run. And it hurt the quality of growth, okay? So that's why the government introduced the so-called 3 red lines restriction on the left. So all these 3 conditions basically limit how much borrowing a developer can take on the balance sheet, right? And also it has a lot of restriction on how much cash they need to stay on the balance sheet versus how much obligation they have to pay in at least the next 12 months, right? So when all these 3 red lines were laid out, honestly speaking, many developers didn't take it very seriously because they think, many of them were just too big to fail. And they bet on the Chinese government probably won't let developers fail because everybody knows a fail on the property sector has a huge negative implication to economy, right? US seen it, Japan seen it, we in Hong Kong, we also have seen it before. So they are betting on that, but by the time companies realize that these 3 red lines research is actually no joke, and it's already too late, okay? So the net impact is a lot of the weaker developers actually has fallen. And I just want to ask a question to the audience. What do you think the default rate for China developer credit last year was in terms of percentage? Take a guess. 10? 20? How much?
60.
Oh, okay. You are close. Actually, it's 70. So that's why it's also known as the Great Purge, right? Because a lot of weaker hand, a lot of developers who should not be there in the first place basically got purged out, just in a matter of 12 months, okay? So what we're left with is a handful of developers that are, first of all, performing. They are well managed, and they have nationwide scale in terms of the business, right? So those, arguably, they are the better company, much better company, better managed. So that the entire exercise ended at the end of October last year, right? So borrowing Frank's description, government headwinds of the 3 red lines all of a sudden become a government tailwind, which we call the 3 arrows, okay? When the government realized that, okay, all the weaker hand, all the company that shouldn't be operating are already gone, they proposed the so-called 3 arrows policy, which is these 3 conditions, basically helping company to refinance, right? Putting more money into the pocket through bank lending, through issuance from the onshore bond market, as well as helping a company to raise additional funding through the equity market. So all these are basically putting more money onto their balance sheet so that they can meet their obligation and service their coupon. So therefore, you see a strong rebound of 142% just in a matter of 1 to 2 months. And that's basically the result of the three arrows policy. Okay, honestly, all the yield has compressed, right? If you go back before, right? You look at the fourth quarter of 2022, right? The markets were yielding 22%. Okay. After the three arrows, the entire market rallies hardly because of the 142% return, and it has right now the yield has collapsed to around 16%. Okay, for 16%, I think it's still relatively attractive because as Jonathan mentioned before, our premium income fund, the sort of long-term average in terms of yield is around 8 to 9%. So we still see a lot of room for credit spreads compression from the Chinese property developers. That said, so the entire sector, they have already embarked the journey of recovery, but we think that the underlying contract sales for wholesale will likely be kind of slow because arguably speaking, the entire sector just will out from the intensive care unit, and it will take some time for the sector to recover. Okay, couple of key takeaways for the audience. Every day we come into the office, we try to at least service the 6% payout for the fund, payable on a quarterly basis. That means 1.5% for every 3 months in terms of income. But in addition, we also want to be very active in managing our portfolio. So under the current environment, we believe that investors should actively pay attention and exploit the trend of global decoupling that I mentioned in the very first slide. And then as far as the relative value, we believe that Asian credit, including China, right now offer very, very attractive relative value versus developed market and even versus other emerging market credits as well. And on our part, we will continue to dynamically manage our China exposure, both the property section and also the non-property section. And in addition, we will also actively looking for values in other Asian country, right? For example, we have long been investing in Indonesia, in India, Macau gaming, which is one bet that we basically betting on the reopening theme when Chinese tourists could once again visit Macau to have some gaming fun. And also we have also previously been investing in some of the frontier country. For example, we have a position in Mongolia. Okay, you may ask why. Jonathan mentioned we have some Israel, and also back to 2015-16 when all the Western country was sanctioning Russia, we went there to buy some Russian debt from policy bank from US dollar, and that has made a pretty good return. And lastly, as Jonathan mentioned, we have the freedom to manage a very active FX overlay from AUD to USD. We can go totally unhedged into AUD or totally hedged into AUD, and that acts as a buffer to basically mitigate the underlying volatility of the bond positions. Here's the track record as well as some of the statistics of the fund. Before the Great Purge, we are pretty happy that we have almost maintained a relatively straight line for the more than 10 years of history of the fund. And as of the latest data point, the fund was yielding around 16% in terms of yield. The cash yield basically is all the combined coupon divided by the fund NAV was around 7.25%, right? So that even on the cash yield alone is enough, is more than enough to service the 6% coupon payable to our investor already. So if we buy into the theme of the China recovery will slowly take shape, that 15-16% yield has great room for compression to our long-term average of about 8 to 9%. This is a fund, this is a bond fund, but so a lot of people will quite concerned about our interest rate move, especially under the current environment, okay? Our fund has always been really, really short in duration, historically around 1.5 to 2 years in duration. So you can think of this fund not so much a fund that is sort of sensitive to interest rate move, okay? That said, this is a fund that we invest in corporate credits. So in a way, it is sensitive to corporate spread move. That means sensitive to whatever happens to the corporation or companies that under our portfolio. We have number of bond position, more than 100 individual bond position, and more than 50 to 60 in terms of issuer. Here is how it looks like at the end of February. Because of the reopening in China, Hong Kong, we actually have increased our China, Hong Kong holding. In particular, the real estate right now was around 27%. Out of the 27%, only 20% is China property. 7% we have property developers position in from other countries as well. For example, we have a developer in Singapore and also a developers in Indonesia. But other than that, the fund is reasonably well diversified across the industry sector. The overall rating of this fund is the highest in high yield, which is BB. Here's a snapshot of the top 10 holding. I would say this list is a combination of stable credit as well as a few of them have film-related and also special situation. Like for example, the number one position in Dika Energy, it is a coal producer in Indonesia. The bond is trading around 99 to 100, meaning very close to par. The bond pay a cash coupon of 9.25%, so that means the yield is also around 9.25 to 13%. And we see it as a very, very stable credit that we can hold and be able to get some sleep, right? So that's why we are very comfortable holding at 4% in our allocation. Number two, GCL New Energy. This is a sort of event-driven name. Basically, this has been a takeover target by Chinese SOE, and the takeover actually happened, right? So right now, this credit basically transformed itself from a private-owned enterprise into an SOE enterprise in just a matter of a few days, and we have made good money on that name. Number three, Yihai is a car rental company in China, okay? And that basically is an expression for our strategy to capitalize on the Chinese reopening story when we expect people to travel more and drive more within China, okay? And the rest of the other, it's just a combination of other stable credit with good business model, and they are mostly industry leader in their field. Oh, Gajah Tonga, okay.
It was originally a good credit, then it became bad credit, you helped them, and then now they're okay credit. Can you sort of walk through that story?
Yeah, this is a very, very long story. The number 7 position in Gajah Tonga is a tire maker in Indonesia, okay? We are always an active credit investor. That means after we bought a position into the portfolio, we always take a very active role to work with the management. For this particular company, it was, as Jonathan mentioned, it was a pretty bad credit in the sense that they have a debt come due, but simply put, they didn't have much cash on their hand, so that's why they have a very difficult refinancing moment. So what we did, long story short for this name, is that we bought into the credit at, I think, 50, 60 cents on the dollar. And then we arranged the company to talk to a local commercial bank in Indonesia. and the local bank basically extend a emergency loan to that company so that they can be able to refinance. So as soon as this news hit the market, the bond price just rally greatly, and to the level where they can actually do refinancing through the public market. So that's what we call it. We were sometimes asked as an activist in credit. So with that, let me just stop and pass it back to Jonathan.
Okay, if I ask Paul, could I ask Frank to come up as well?
I'll moderate it from here.
Oh, I'll moderate from here. Thanks for all the great questions that have come up. Just what's on the screen here gives you an idea of our distribution history for the last couple of years, just in tabular form. I'll skip this last question. So as I said, some great questions coming up on the screen, so please vote them up or add questions as you see fit. I thought I'd start from the top. China is appearing militarily aggressive towards Taiwan. Surely investors will flee in droves. If a conflict occurs, what is your get out strategy? Now, I think, Frank, you sort of half answered the question already because, our portfolio is tuned towards the localization story. So I guess have at it in terms of your interpretation of get out strategy. There's not much that we need to get out.
Yeah, I think you're right, because we have been trimming some Taiwanese exposure, not entirely because of the geopolitical tension, but also about other fundamental changes. But I mean, this I don't have a crystal ball, and it's getting it's getting to a level that we think this is a risk that we should also consider. I think back 2 or 3 years ago, it's a non-event. So we don't think this is going to happen. But I think it's also about because China is more of a reactive, while the U.S. is more proactive in the forcing or driving the geopolitical tension in the last few years' time. I don't think China, would do anything that will jeopardize the growth of the economy, unless they are being pushed to an area that they have to respond. So. I think, but that's, on political level that I'm not an expert of that. But I think from just an investment portfolio perspective, there's not much that we could do or we need to do at this moment, given the exposures that we have, and also about if you're asking some sort of level Ukraine situation, that the Russia market is being sanctioned. I think this, I cannot always rule out this possibility, but I think this is less likely relative to the Russia situation, because Russia is way more aggressive than China in the past, and I think the overall connections between China to the rest of the world is also very different and way more complicated than the Russia situations. So it's not coming with a zero cost if China is going to continue to be more aggressive on Taiwan, and I think everyone knows about it. So I think the consequences is way bigger than the Russia-Ukraine situation, if that's something that relate to this level of intensity.
I think there's probably two other points to be had, because this is sort of the general question that we got from New Zealand as well. I would reverse the question, also say if China is militarily aggressive against Taiwan and the US steps in and starts a conflict, what's your get out strategy for your entire client's portfolio? You're not having another review with your clients ever again, trust me. right? Let's think about the actual practical implications, right? And that's why I said before, right? China is, as Li Keqiang has said, Li Qiang in his press conference said that it serves no purpose for the two largest superpowers to go head to head. But Biden wants to go head to head. It's like he's just winging it at the moment, right? Let's face it, it's not that China has said anything that says that we want to go do anything in any urgent rush, right? Everything that even we're doing here in Australia has the same consequences, right? What we've been talking about, subs and whatnot. It's not constructive, right? And so that's why I would like to reverse the question in regards to what is your get out strategy for your entire portfolio. The second question there is, can we trust the official inflation data for China? I guess that can be the same question of, do you trust the GDP growth number that comes out of China? Who cares? And I mean that in the most genuine sense, because it doesn't impact our portfolios, right? GDP growth in Australia of 2%, does that really alter your portfolios? It doesn't really, but Frank?
Yeah, let me add to that. I think, official data is something that gives us guidance or reference. But I think we always, go out and do channel checks about, the price impacts, supply chain changes, what sort of like cost pressure that, the individual companies is, facing. So I think it's not, only about, the official government data. I think Chinese, official data, including PMI, they come with like different numbers, like PMI, Caixin, surface production PMI. We use that as a guidance, but I think as a bottom-up stock picker or research manager, I think what matter most or what we trust is more about the channel check data that we acquired in our research. I'm not sure if Gordon wants to add more.
Yeah, I totally agree. Because number is number. It is just a number on the paper, right? So you need to get your hand and feel the pulse. Online, on the ground research is very important. So whether we can trust China data or not, or any number from China or from other country, the key is you need to do your own work, be on the ground, feel the atmosphere and feel the pulse, and that will basically help you a long way.
The next question is, will the containment policy of the United States, notably controls on technology companies, crimp China's growth aspirations and ability to fulfill its own innovation agenda?
Definitely, yes. I think let's take semiconductor in China as a reference. We used to have some semiconductor companies in the portfolio, but since the sanctions, since the restrictions that is applied to China, we just realized these companies will take long time, much longer than expected to grow. So the answer, the short answer is yes. And I think if this continue, and this is also the reason why we shift the focus to other, innovation sectors, such as, what I mentioned about the industrial-related innovation, that is less sensitive from a national security perspective, because semiconductor, all this like consumer electronic, goods, that could be very sensitive because of the data transmission, and that kind of like touch on the national securities by different Western countries. So and we come to a very detailed analysis just about when the policy rolled out 2 years, 3 years ago, and that's a conclusion that we have. So I think it's innovation could come with like different formats, and currently industrial innovations, it seems to be something that China has an edge and is quite advanced, and also is not easy to be taken away. So that's something that we had conclude from our research.
Gordon, do you have any comments on this?
Innovation.
Not really? Okay. So here's one for Gordon. In light of the banking failure in the United States and Europe, do you see a squeeze of credit availability coming, and have you seen any outflows out of Asia or China? I mean, this is really a last 2 weeks sort of question.
Yeah, I mean, just for the last 2 weeks, we haven't seen much outflow. We actually see some inflow, well, to our advantage because, ironically speaking, the Asian credit market was actually very, very bad last year, right? So we started on a very low base. So because of valuation and also the particular fundamental going on in Asia, including China, that we actually seen some inflow into some of the area. And as far as financial crisis is concerned, as Jonathan mentioned earlier in this presentation, there's no banking has ever failed in China, and we continue to hold the view that the Chinese government will have to bail out, and also. And also, I'm not sure if you guys have heard any description about the Chinese government. Right? Chinese government is very, very stubborn, and also they are control freak, right? They control everything. They are really, really allergic to systemic risks. Whenever they see a systemic risk, they will try to tackle early, fiercely, okay, to make sure it won't pop up. What they have done to some of this sector in technology and in property, we have seen how they do things, right? Although sometimes could be brutal. But I think at the current stage, we do not foresee a financial meltdown or kind of similar banking crisis happening in China.
I think that the other interesting point is that sort of contrasting the way that the Chinese, and let's just say the US for the moment, given they're the ones in the headlines, the way that they handle risk. Because China, as Gordon said, control freaks, totally allergic to systemic risk, won't let it happen. So with all the property crisis of last year, 70% of property bonds defaulted, not a single bank collapsed. Not a single bank collapsed, right? Systemic risk that's the way that China deals with it. Most other Western economies, like the US or Europe, what they'll do, will just push it down the can. It'll be someone else's problem. Because if you fundamentally think about it, the problem's only gotten worse in the last 10 years, right? The polarization and all the other demographic issues we have, a lot of it has been driven by policy standards that were enacted and decided post the GFC to basically say, it's not going to be my problem because I won't be the Fed chair in 3 years' time. It's going to be someone else's issue. Whereas China just goes, no, we're just not having this. We're going to cut it out. I always say China needs a really good PR firm because they have all the nuance of delivering government policy like a sledgehammer. But other than that, what they generally do is trying to, as people criticize them for, is that what keeps them in power. But what keeps them in power is to keep the people happy. So while you may think that this is all about, the old communist days, it's not, because they're actually trying to keep the people happy. Because if you consider the property part of it, again, there's two lenses. One lens is the operating company, which is the property developer. The second part is the actual development they're building. They don't want systemic risk in the latter. But in the former, they couldn't care. Irresponsible property companies should have been punished, and they were punished duly. And the result of that is that people are still getting delivered their properties in China, right? But it cleanses the system. And that's why when we're talking to clients now post-October, it has never been a better time to invest in Asian credit because of the simple de-risked system that we're in now. And I've asked Gordon the question, normally, for those of you that have tracked the income fund for a longer period, our cash yield is generally somewhere between 700 to 900 points, and our yield to maturity under a normal non-crisis type scenario is around 10%. Okay? But right now it's 15, so there's still an 800 basis point spread. And does that create a lot of risk? I just might let Gordon answer the question. In previous cycles we would say 15% is crisis, but is 15% really crisis, Gordon?
Everything is relative, right? So if your funds face 5%, everything is got priced higher, right? So right now at 15, 16%, I think in terms of credit spread is still very, very attractive, especially after the Great Purge.
Yeah. Paul?
I just wanted to remind everybody too of a few of the points that came up in the video with Premier Li Cheng and with some of the points. Remember those numbers when we're talking about the domestic economy in China and being able to grow and achieve its growth just from that. 900 million in the workforce, 15 million added every year, the greatest rise in people moving from poverty into the middle class, probably in the history of mankind. There is a domestic economy that is extraordinary and is still growing strongly. When you look at those numbers, adding 15 million to the workforce every year, let alone the rise in living standard of people coming through. I think it's another 150 million people due to move into the middle class in the next little while. There is a strength there that is quite unique in the current world circumstances, particularly given that there's not high inflation.
We also need to think about from the perspective of history. If you think about the last time a nation challenged the United States as to be the highest ranking power in the world, that was Japan. What did the US do? They basically destroyed the Japanese yen. If you destroy the currency of the country that is challenging you, that's cool. The impact of that is that Japan was producing all these widgets and technologies and things that were all for export. And overnight, they couldn't export anything. So the only way you counteract that is to allow your internal population to assume consumption power of those goods that you produced. And Japan could not do that. China is well versed, and the government is well aware of the containment policy that the US is trying to ring fence China to a certain extent. And hence, they have the population of 1.4 billion people to basically take up that consumption burden within inverted commas, right? And so, this is going to sound a little bit funny, I guess, but we've got white liquor companies in the top 10 of our portfolio, right? If something happens, people are going to drink. If nothing happens, people are going to drink, right? They're probably going to drink more if a war breaks out, right? But the reality is that if your entire supply chain is locked into China and you're producing white liquor, you're wholesaling and retailing, consuming it in China, what's the risk? What is the fundamental risk? Which is why I said at the beginning, it's all about a localization story. You're investing in China for China because you're not investing in the BMW in all these places, right, for the sake of that. Because here's a statistic. In last year, China sold 6 million BMWs. 6 million BMWs. Guess how many BMWs India sold? 6,000. You wouldn't believe that for a minute. China sold 6 million. India sold 6,000. So if you're looking for an economy that has the ability to absorb consumption power, it's China. Frank?
Yeah, because I look at these questions, and I think there has been a lot of concerns about the credibility investing in China. Just maybe I could just give two more examples that illustrate, how we do things. Because remember, like the inflation data, the questions about that. I think we as an asset manager, I said, we took that as a guidance, but we really dig deep on, to understand what is actually happening there. There was one example that we went for a company due diligence. So we met with the management and they said, okay, we do, they manufacture the sports shoes. So they said certain amount of production per day. That's the first time that we went and to do on-site due diligence. What we did was the next day we hired someone to stand in front, or actually not stand in front, but hide in front of the factory gate, just to count the number of trucks and cargoes that is going out of the factory and try to match the number that they mentioned.
I talked about the story already.
Yes.
Yeah.
So is that something that we want to know what is actually happening instead of just trusting the data that we were given or told. The other example was I went to BYD factory in Shenzhen. That was about 3 to 4 years ago. I was there physically there because they had a couple of new models that they said is much better than other Japanese and European brands, on the SUV. That model number is called Qin. Qin is actually one of the Chinese Empire name, so they name it with that background. So I went to see the cars. So they were very nice to set up. They arranged a Porsche Cayenne, because that's an SUV, the RAV4, RAV4, Toyota, and I forgot the other ones from Volkswagen, and literally the Qing model. So what they do is they set up like a row that they intentionally trap the car in a hole and see how long it takes for that SUV to get out from that hole. So initially they claim, oh yeah, the car is way better than other brands, but we went to see. So they demoed. So Cayenne, RAV4, and then Volkswagen, and lastly it come with the Qing, and obviously the car stuck for over like 2 minutes and couldn't get out, and just told us, maybe it's not a good day to demo that car. But this is something that we come across throughout all these years of researching Chinese companies, is that I think it's important that we know our company and we know the management that we're dealing with, or the possible risk that we may anticipate by investing in different companies. So I think investing in China is not easy, but it's just really about doing research and having the on-the-ground people just to go and meet with the company's management and get a sense on if they are good quality company. I could still say there are still a lot of good governance, good quality private company in China. But of course, I know there has been a lot of talks about credibility. But in other emerging market, we are all dealing with the same situation. So yeah, this is something I just like to share a little bit more about the experiences.
So just the next and probably final question, because we're out of time, is what's the difference in investment philosophy between Fidelity and us? I'm not here to comment on other fund managers per se around investment philosophy. That's not my job. But in terms of what I understand in terms of mandate, so that's objective, right, is that they run a different mandate to us. They run a high conviction type strategy, right? So they've got far less stocks than we do. We decide to spread our portfolio out a bit more, we believe it's a better risk mitigator. And obviously we're value and we have 50 men and women on the ground, right? So that's probably the best way to objectively answer that question. As I said, we're right on 2 o'clock. I don't want to keep anyone from their important work. As long as you've registered your name when you came in this afternoon, you will receive your CPD points. As part of that, you will get the feedback form. Please let us know if there is a platform that you want to see us on that's not there. All the research will be available for you, as well as a copy of these slides. So on behalf of the team, I'd like to thank everyone for their time today, and we look forward to seeing you soon. Thank you.